Today we are starting a new series. This will be a regular series every 6 months or so, at which we want to look at the key group of emerging market economies that we call the $1 trillion club. That means the countries who are now having economies that, well, this should work. Soon it will work, I'm sure. Hopefully it will work. There we go. All right, now it works. The $1 trillion club. There's another outfit, financial institution now undergoing some structural changes that gave a different term to a somewhat similar group of countries. But we label it the $1 trillion club because these are the countries that have reached $1 trillion a year in terms of GDP, either at purchasing power parity or at market exchange rates, or in most cases both, and we think therefore make up the sort of creme de la creme. They're about half of the emerging markets as a whole, which in turn, as I'll say, are about half the world economy, and we therefore think these are pivotal players. The 5 countries on which we will focus in our series, starting today, are China, India, Russia, Brazil, Mexico, Brazil and Korea. Mexico is just about at that $1 trillion level now, and so we may be adding it in the future. But this is the group of 5 countries on which we are now focusing. They're obviously, as the chart shows, not yet up to the income levels of the United States or the EU, but at least on PPP grounds, China has already long since passed Japan, India is getting close, and this group of countries clearly is moving into a prominent role in the world economy. The other reason that we are emphasizing this group is because we have now assembled here at the Institute a high degree of expertise on all of them. Nick Lardy on China. We show here our most recent publications on all the countries. Nick Lardy, in particular, and I have co-authored a new book on China called China's Rise that we'll be releasing in a couple of weeks. Arvind Subramaniam on India, Anders Osland on Russia, John Williamson on Brazil, and Marcus Nolan, who cannot be with us today, on Korea. But we feel we have a capability on these key $1 trillion economies who are becoming so important to the world that we want to share our thoughts with you from time to time and hopefully add further to the discussion on this key group of countries. Now, we emphasize this group because, as I say, they are becoming critical to the world economy. If you look at purchasing power parity exchange rates, the group of emerging markets as a whole literally makes up half the world economy. If you use market exchange rates, it's about 1/3 of the world economy, in either case a very major component thereof. The $1 trillion club, in turn, is about half the half, so roughly 1/4 of the world economy, just these 5 countries, in terms of PPP exchange rates, or about 17 to 18% in terms of market exchange rates. In any event, whichever set of currency conversions you use, the crucial point is that these economies are growing 2 to 3 times as fast as the rich countries. The emerging markets as a group, as this chart shows, have been averaging 7% growth over the last 5 years, including best current estimates for 2008, compared to about 2.5% for the rich industrial countries, so almost 3 times as fast. Well, it doesn't take a PhD in math to know that if one group is growing 3 times as fast as the other, then its share of the total is rising by something like 2 percentage points per year. And so not only are these countries already big players, but they are becoming even bigger players headed down the road into the future. If you project, even on fairly conservative numbers for these countries, out to 2025, you find that the emerging markets as a whole will be close to half the world economy at market exchange rates, and by that time, 60% to about two-thirds of the world economy at PPP. And again, the $1 trillion club, just these 5 countries alone are about half of the half, and therefore, at this point, more than a quarter of the world economy as a whole. The bottom line in terms of impact on global economic development is simply that this group of countries has become one of the, if not the, chief drivers of the world economy as a whole. The emerging markets at PPP making up about half the world, growing at 7%. That means that even if the rich countries grew at 0, you'd have global economic growth of 3.5%, which is not bad, certainly far from global recession. China, of course, is by far the most important single country. It accounts for about 10% of the world economy at PPP rates. It's growing at about 10%, so it alone accounts for 1 percentage point of global growth. And since global growth is now a little less than 4 by Mike Moose's upcoming forecast, China alone is accounting for more than a quarter of total world economic growth. But again, the $1 trillion club as a group is providing a very major emphasis. One key question, and we'll talk about that today and in the forecast on Friday and in many of our presentations, is whether there has been a significant degree of desynchronization between these emerging markets, and particularly the $1 trillion club, from the U.S. and the rich country economies. That's sometimes called decoupling. I've used the term myself, and that may be misleading because it could imply some reduction in international integration, which of course is rising, not falling. But what has been noteworthy in the current period, at least up until now and the intensification of the financial crisis, is that the emerging markets have continued to grow in the 6+7% range, even while the U.S., Western Europe, and Japan have slowed down markedly. Some degree of decoupling in that sense, maybe desynchronization is a more apt word. All this, of course, is not only important because of these countries' size in the world economy, but it also raises some very important structural issues. For example, China uses 3 to 5 times as much primary products per dollar of output as the United States and Europe. So if global growth shifts from the older, richer, mature industrial countries to China and somewhat similar emerging markets elsewhere, you get an enormous upward shift in demand for energy and other primary products. Not a new phenomenon. We know that's been a major cause of the rise in energy and other commodity prices over the last few years, but that is a key structural spin-off from the increased role that these countries play in the world economy as a whole. Another important structural impact may come from the change in the growth patterns of the $1 trillion club itself. Most of them, until recently, have been running large and growing trade surpluses, relying on those increased external positions for an important part of their economic growth. Now, we think at least, those imbalances are beginning to reverse and be reduced. We know that the U.S. trade deficit, for example, has come down sharply. My op-ed from last week's Washington Post is in your packet, using numbers on real U.S. exports of goods and services, as included in the GDP numbers. The U.S. external imbalance, while still very large, has already come down by 1/3. By the end of next year, it should have come down by 50% in volume terms. And that, of course, implies that the corresponding surpluses elsewhere in the world, including notably in the emerging markets and particularly the $1 trillion club, will be coming down as well. That in turn means, as has been called for in the case of almost all those countries, there will be an increased reliance on domestic demand growth within those countries. That means an important shift from tradables to non-tradables. It means important alterations in the demand patterns that those countries will be injecting into the world economy as a whole, and therefore another important implication in compositional terms as well as in the simple magnitudes of growth of the countries themselves. Now, within this broader group of emerging markets, the trillion-dollar club, we think, does and will continue to play an absolutely critical role. As I said, and the earlier chart showed, they account for about half of the world economy that is represented by emerging markets as a whole. I would stress at the outset of our series that China is clearly premier inter pares at this point in time. You know some of the characterizations of that. China and India are frequently lumped together, but the annual increase in China's trade flows exceeds the total level of India's trade flows. The annual flow of foreign investment into China exceeds the cumulative total amount of foreign investment into India since its independence in 1947. So China stands far above the other members of the trillion-dollar club at this point. Its continued growth looks like keeping it in that position, and it therefore is by far the most important of the important group. The final point to make is that this group of countries is, of course, very important in financial terms as well as real economic terms. That's particularly critical in the current global financial position. But just to remind you of just how important these countries are, and this indeed may be the most dramatic statistic at all. 4 of the top 5 and 5 of the top 7 holders of foreign exchange reserves in the world are the members of the trillion-dollar club. And that's even including the European Union as a single currency area, which it is with the euro. But even looking at it individually, and with only Japan as the other rich country in this group, 5 of the top 7 holders of foreign exchange are literally the members of our trillion-dollar club. And in a world where the inflow of investment from them has had a big impact in leading up to the crisis, and their decisions going forward with their investments will have a big impact on the outcome of the crisis, I think we can highlight the importance of this group. They clearly do have 3 significances. Their investments here and elsewhere in the world certainly helped keep interest rates down and at least contributed to the housing bubble and all the chaos that has followed. Their concerns about the continued value of their dollar investments certainly was a factor in the decision by the U.S. authorities to respond as aggressively as they have over the last few weeks. And we hope that continued growth in these countries will continue to provide a positive engine for world economic expansion as a whole, limit the spillover from the financial crisis to the real economy, keep the world economy growing in that 3.5% to 4% range, despite the sharp slowdown in the rich countries as a whole. So it's not too much to suggest that the world economy really is now heavily dependent on the trillion-dollar club, the emerging markets as a whole, and therefore we felt important to take a look at this group of countries in an intensive way and in an ongoing manner. The final point is, of course, the role of these countries in global economic governance. As their economic and financial importance has increased, their right to play a bigger role in governing the world economy has certainly increased with it, as has their responsibility for helping to assure an effectively functioning, prosperous, and stable world economic order. We've studied that at great depth here at the Institute in terms of IMF positions, WTO positions, and the judgment, which I think is widely shared, is that these countries have not yet either been accorded the positions to which their new economic weight justifies, nor, when they have they stepped up and assumed responsibility in a way that they need to do in order to make sure that the world economy continues to move forward on a positive vein. There are problems at the IMF in terms of quotas and chairs. There are problems at the WTO, as indicated by the recent breakup of the Doha round. And so the role of these countries in global economic management and governance is also a central issue. The Doha outcome, incidentally, I think illustrates several important points about the politics of these countries' global economic role. In the final breakup at Geneva in July, there were clear differences among the members of the trillion-dollar club. Brazil wanted to see the negotiations proceed and succeed, whereas India, with strong support from China, blew up the negotiations. There was discord between some of those trillion-dollar club members and many of the poorest developing countries in the WTO, which also wanted to see the negotiations succeed. There have been disagreements among these countries in the IMF. India, Mexico, other major emerging markets are as critical of China's currency policy as are the United States and Europe. And indeed, many emerging markets, including other members of the trillion-dollar club, are quite worried about China's competitive position, particularly when artificially enhanced by currency manipulation of the type that China has carried out for the last several years. So the trillion-dollar club itself is certainly no monolith in terms of its engagement and its attitude toward global economic affairs, and that is part of the mosaic of trying to integrate that group of countries into world economic institutions and order in a way that is clearly necessary in light of their weight and their role. So, on the basis of all this, we believe that this topic, the trillion-dollar club, as we like to call it, is an extremely rich set of issues, extremely important in terms of its impact on the world economy and the governance thereof. We're delighted to launch this series today. We will have presentations on each of the 4 largest of the emerging market countries in order by Nick Lardy on China, Arvind Subramaniam on India, Anders Oslund on Russia, John Williamson on Brazil. I'm delighted we can bring this series to you. We look forward to your reactions and hope it will be worthwhile. Thank you very much.
Thank you very much, Fred. I do want to begin by saying a little bit about the medium and long-term outlook for China. I do think China does have the potential, with the right set of policies, initiatives, to grow at roughly 8 to 9% per year. And indeed, those are the numbers, they're the range of performance that's built into the diagrams going forward to 2025 in Fred's presentation. And thus, as Fred said, China is likely to continue to be both far and away the largest of the emerging market economies and to be the largest contributor to the rising share of global GDP accounted for by emerging markets as a group. But what I want to talk about today is really the short term, and I think the key question is whether or not China can sustain the double-digit growth rates that it's had in recent years and thus help to cushion the global slowdown that is now underway. If you just look at the last right-hand side of the diagram, you can see we've been through an unprecedented period in China. We just finished the only 5-year period in China's 30 years of economic reform in which growth has averaged, or has been above 10% in every year and has been accelerating. That is higher than it was the year before. So the question I'm posing really is, can we continue at double-digit growth rates and then thus give a big boost to global economic growth as developed countries begin to slow down? And the short-term answer is almost certainly not. And I begin by just showing you recent quarters. And the interesting thing is when you start breaking down the data and looking at it on a quarterly basis, you can see that the growth rate of China peaked in the second quarter of 2007 and has now come down by 2.5 percentage points and has undoubtedly come down further in the third quarter of this year. So the key questions are obviously, will this slowdown continue? And to answer that, you have to look a little bit at what the sources of growth have been. Why have we gone through a turning point? Well, the obvious one to start with is the external sector. And this is a diagram that shows what's happening to the growth of China's trade surplus. And as you can see, beginning in the second quarter of 2007 and continuing up to the present, the growth of China's trade surplus has shrunk dramatically. And indeed, in the last 2 quarters, we are in negative territory. That is, the trade surplus on a quarterly basis compared to the prior year is smaller. And you might think that that means that the contribution to economic growth of the external sector has completely evaporated. But when you take into account price changes and try to do it in real terms, it appears that the slowdown in the external sector, that is the contribution of the external sector to economic growth, accounts for about half the slowdown, and the rest lies somewhere else. And I do want to say, and Fred mentioned this already, China is very vulnerable to an external slowdown because it has relied to a considerable extent in recent years on the external sector to add to economic growth. As you can see, in each of the last 3 years, a little bit more than 2 percentage points of economic growth has been accounted for by the expansion of the trade surplus, which led to a record current account surplus of more than 10% of GDP last year. If the external story is maybe half the slowdown, the other half is in investment. Domestic investment, as you can see, reached a peak, a recent peak in the second quarter of 2007 and has been coming down. It's declined about 40% in terms of the growth rate. That is, it's gone from 25% growth to 15% growth. It's mostly so far in the construction sector. Construction has slowed down quite a bit, but I think it will probably spread as export growth continues to slow and will reduce the demand for investment in manufacturing, because about 1/3 of China's manufactured goods are currently exported. The other thing to worry about is growing uncertainties in the real estate sector, particularly in the housing market, which accounts for 10% of, or investment in property accounts for 10% of GDP, an extraordinarily high number. I don't, in fact, know any other East Asian economy that has ever been that high in their periods of rapid economic growth, whether you're talking about Japan, South Korea, or Taiwan. And what we are beginning to see is a significant slowdown in housing. It's reflected in several things. First of all, prices, which had been roaring ahead through most of 2007, are still going ahead slightly, but at a much, much lower rate. On the official index, August was the first time there was a month-over-month decline in housing prices. There's been a very substantial decline in transactions. As you can see, the growth of floor space sold has been in negative territory for all of this year, so we're having a very substantial slowdown in sales. And I think the slowdown in sales is a harbinger of probably further declines in the price trends. That is, prices will actually start going negative in the housing sector. Mortgage lending is also down substantially. Construction slowdown is very substantial and is having a big effect on the industrial sector. The last 2 months, for example, have seen the slowest pace of industrial growth in China in the last 5 years. Cement production, which was normally booming at 20-30%, is now flat. BioSteel, China's largest steel company, recently announced price cuts for a wide range of products used in construction, and that's unprecedented any time in recent years. Well, that leaves us last to look at the consumer sector. I don't have a diagram for this. Many people are optimistic here, saying that retail sales growth is very strong, but the retail sales numbers also include wholesale trade, and when you get to a turning point, the sum of retail and wholesale trade isn't going to tell you very much. I think inventories are growing. We've certainly seen it in cars, with a record accumulation of unsold cars in the first half of this year. For the first time in years now, car production is going down. It's growing at more than 20% in 2007, more than 20% in the first half of this year, and car production is now down 6% in August. They're producing about 345,000 units per month now as compared to 500,000 units a month earlier in the year. So I don't think the consumption side also looks a little bit weak despite the positive retail sales numbers. Now, what's the outlook, or what's the bottom line here? The consensus is still for fairly strong growth, about 10% this year and 9.3% next year. But that is mostly on the assumption that policy adjustment to the slowdown will be vigorous. And indeed, we've already seen some interest rate cuts, which many people are interpreting as one of the initial responses, monetary loosening. My own view is that if expectations in China are for lower property prices and profitability in the export sector weakens further, that monetary easing will not stimulate either property or manufacturing investment, and that could continue to slump. The prospects for fiscal stimulus are somewhat limited. There's already been too much investment in some components of infrastructure, for example. There's room for more government consumption expenditures, but government consumption is only 14% of GDP, so even a large percentage increase will not add that much stimulus to the overall economy. Obviously, you can do some on that side. It seems to me the risks are all to the downside at the current juncture. We have the drag of a sharply declining stock market. Now, it has been up 18% in the last 2 trading days, which is not reflected on this diagram, but even taking that into account, the Shanghai market is down more than 60% from its peak of about a year ago. So very sharp stock price correction. A further weakening in the external sector, if global growth slows, as some are forecasting now, could easily erase another 2 percentage points of economic growth from China's headline growth number. Further weakening of investment would drag growth down further. And I do not share Jim O'Neill's view this morning in the paper, saying that increased household consumption in China is going to help to offset the slowdown in the United States. In the book that Fred mentioned, China's Rise, which we're just publishing, I've done a pretty exhaustive analysis of China's attempts to rebalance its economy, and I don't see anything in the pipeline that is going to reverse the trend. And the trend is that household consumption as a share of GDP has been declining now for 7 consecutive years. It's the lowest of any country in the world, and I don't see anything in the policy pipeline that's going to turn that around anytime quickly. So in summary, and talking a little bit about the implications, I think number one, remember that China is very exposed to the global slowdown for the reason that Fred mentioned in his initial remarks. It's been very heavily dependent on expansion of its trade surplus to generate economic growth over the last 3 years. I think China's outsized contribution to global commodity price increases is falling and likely will fall substantially going forward over the next several quarters. I also think China will be a substantially less robust contributor to global economic growth. I think we're headed for 1 or more quarters of growth below 8%, and I think growth in 2009 could be something very close to 8%, which would be a very substantial reduction from the almost 12% rate of growth we had recently. Corporate profits as a share of GDP in China are at an all-time high, and they are likely to plummet over the next few years as growth slows, which I think will create enormous stress in the financial system. So I think as we go from roughly a 12% rate of growth to an 8% rate of growth, admittedly a rate of growth that any other country would be happy to have, except maybe India, there will be lots of stresses and strains in this economy, and I think this economy, as I said, has the potential to grow at 9-10% per year in the medium and long term, but I think we are or have passed a turning point, and we are going to see sharply lower growth over the next 2 years. Thank you.
Thanks, Fred, and thank you all for coming this afternoon. Notice how it took the $1 trillion club and the $1 trillion financial crisis for Fred to embrace technology. It's the first time he's used PowerPoint. So I want to do 3 things in my presentation. Talk about why India is on the radar screen more and more. Second, talk about the current conjuncture and what's happening to India as a result of the financial crisis and what the short-term prospects are. And then finally, I want to talk briefly about India's medium-term prospects. So why is India on the radar screen? And there are 3 elements of economic hard power, one might call it, which India is gradually acquiring or has acquired. Size, it's now, I think, the 5th largest economy in PPP terms. Second, dynamism. This is a country that has grown at about 6% or just over 6% for 30 years. So China and India have been growing fast for about the same time. It's just that China has been growing at 10% nearly for 30 years, but India has been growing at about 6%. And in the last 5 years, it's grown at 9%. So size, dynamism. and growing integration. So India, which was the exemplar of inward-looking dirigist policies, has actually made great strides in becoming more open. Its trade to GDP is close or just above 50%, and there's been a dramatic change over the last 10 years. And of course, the final point is, if you've been listening to NPR ads by the Indian Embassy, they call it the fastest growing free market democracy. So to put it kind of graphically, why India is on the radar screen is because it's from becoming the exotic poverty-stricken India. It's an India that's integrated to the point of threatening jobs in the US, and an India that's going to produce the world's cheapest cars. So that's why I think India is more and more on the radar screen. But then I think this is straying beyond my scope of expertise. I think why India is on the map in Washington sitting today, one can't not note that nukes are some part of why India is on the radar screen. And I would say that the US has got the best deal since the Louisiana Purchase, because it's going to ship us a few nukes, and in return it's going to get, guess what? Juicy, delicious, the king of all fruits, the mango. So this is a really unequal bargain here. But there is another reason why India is I think, interesting and it's on the radar screen. It's what I call the precocious India phenomenon, which is that India is exhibiting a fairly atypical, unusual pattern of development. It does less manufacturing than, say, China does. It does a lot more services, which has been noted, the IT revolution. It does a lot more skill-intensive activities, both in manufacturing and services. And most interesting of all, this is not about skill, just about writing cheap code sitting in Bangalore, which is what it used to be. What I think is truly interesting and worth studying is that India is now becoming an exporter of what I would call managerial and entrepreneurial capital. And it's not just interesting, but it's also very ironic if you think of the fact that only 30 years ago, India threw out IBM and Coca-Cola because it did not want to play the global capitalism game. But now, indeed, it seems to be engaged in this, not just by contributing labor, but by contributing managerial and entrepreneurial capital. I want to show this chart as kind of the starkest illustration of what I call the precocious India phenomenon. Fred, for example, mentioned the comparison between China and India on inward flows of FDI. And that's all true. But if you look at the outward flows of FDI, exports of FDI, it's really remarkable. And not just exports of FDI, but if you look at exports of FDI to OECD countries and rank all countries in the world, India is the second highest in the world after the United States. This is average over the last three to 4 years. This is a paper that Aditya Mattu of the World Bank and I are doing based on some very detailed data. But in some ways, at this level of income, for a country to be exporting so much FDI, which, if you think about it, is managerial and entrepreneurial capital, is pretty interesting and pretty striking. And of course, the newspapers have been full of, the Tata acquisition of Chorus, and Lakshmi Mittal, the works, lots of FDI. In fact, the recent Economist piece on globalization, the theme is very much about developing emerging market exports of FDI. But in this, India really stands out. And even if you compare with China, China is way below India in terms of the outward flows of FDI to OECD countries. What about the near term? What's happening? As I said, India had very rapid growth, 9% for 5 years. But there are, I think, strong signs, if you look at the last 2 quarters, that growth is slowing down. In the latest quarter, I think GDP growth was just about 7.5%, and the expectation is that this is going to decline. And 2 reasons for that. I mean, the external environment is certainly more unfavorable, and a consequence of having integrated more is, of course, on the flip side, you're more immune to the downsides of external downturns. And also, there's been policy tightening in India, especially on the monetary policy side. Both of these have contributed to a slowdown in growth. But the big concern in India until very recently was not in fact growth and the slowdown in growth, because it's still at about 8.5% on average, is what's happened to inflation. Inflation around late last year really took off, mostly as a result of food price increases, but also commodity and oil price increases. And the headline wholesale price inflation number is well above 12%. And even the CPI has edged above 8%. This has caused a lot of distress and concern amongst policymakers, because, as I've said before, there's kind of an iron law of politics in India, which says that any incumbent that holds an election with inflation above 5% stands a really serious chance of losing the election. So it's way above the political comfort zone, and the dilemma is, how to bring it down. Like in many other emerging market economies, asset prices have come under pressure. The difference, you have the stock market index, which is the green line, coming down since, again, early this year, and the currency in orange has started depreciating quite rapidly, about 20% since the beginning of the year. And the difference with other emerging market economies, or the BRIC economies, or the trillion-dollar club, is that this downward trend in asset prices actually began earlier than what's happened, say, in Russia or Brazil. And so in the most recent episode, it's been actually more muted, these changes, than in Russia and Brazil. So really, the near-term policy challenge is actually, given that growth is slowing down, and given the fact that at the moment there is some limited spillover from the financial crisis, not a whole lot yet, but that's all contingent on the US and Europe chugging along at current rates. But if the US and the EU were to turn down significantly, say into recession, growth in India would be significantly affected. But the real problem, therefore, what it's created is that the scope for easing has been limited because inflation has been very high, and the rupee has been declining. So I think the real policy dilemma in India is how to bring inflation down, given that the rupee is declining and there are all these spillovers from outside. And inflation is still above 12%, as I said, and I think there is concern that it needs to come down before the elections, which are likely to be held no later than, say, April or May of next year. So that's about the near term, and I want to spend just a few minutes on the medium term. So if you go back and analyze India over many, many years, we had kind of three eras. One was the Hindu growth era, where growth was slow because investment was low and TFP growth was low. Then you had about 20 years of what I call the turnaround, about 6% rates of growth, where investment remained low, but total factor productivity rose very sharply. And then what we see in the most recent period is what I would call the takeoff phase, where you have both not only high TFP growth, but it's been accompanied by really very, very dramatic increases in private investment and overall investment. And really, investment in India is now approaching 40%. It's close to East Asian levels, and this is kind of the basis for the high rates of growth in the most recent period. So what is my forecast for the medium term? I think if you, provided one rides through the current turmoil in international markets, I think the feeling still is that growth in India is medium-term growth is about 8%. It's what we projected a few years ago, and I stand by that projection. And of course, the reason for that largely is the fact that there's been a decisive change in policy. The private sector is in charge. As you can see, the private sector has responded. Private investment has grown enormously, and barring major glitches, I think one can reasonably expect this to continue for some time. Now, challenges. There are many, many challenges to the medium term. Skills shortages. Indian growth is based on skills, but skilled wages are growing at about 14% for about 10 years. Serious shortages. Anyone who's been to India knows what the infrastructure is like, and of course, governance remains a problem. And one has to accept and recognize the fact that reforms in India will be steady but absolutely unspectacular. I mean, although we may have gotten over the Hindu growth rate, but the pace of policy reform is going to be very much slow and steady. As people quip about India, the Indian system has, the wheels of a bullock cart and the brakes of a Rolls Royce. So there's an inherent bias towards stability in the Indian system, so don't expect very rapid policy reforms. All that being said, I think one has to conclude with optimism. Why? Because the private sector is in charge now. We're a nation of hustlers, as someone said. And what is, I think, pretty interesting is that the very fact of growth itself has generated a lot of positive change and has allowed the private sector to overcome many of the deficiencies in the public sector, including of public policy making. There are a number of examples of this where growth creates a demand. That demand can no longer be met by the public sector, or public policy fails to respond, and the private sector just gets around that. So it's a story about constrained adaptation by the private sector. And finally, I think there's this really interesting dynamic in India where there's a lot of competition between states. India is a large country, many jurisdictions, with a lot of control over economic policy increasingly. And so if some states start doing well, there's a demonstration effect. There's kind of a race to the top in terms of being able to attract policy, attract investment, and undertake good policy. So on balance, I would conclude by saying there's, the Indian economy one can expect in the medium term, provided we tide over the crisis, of about 8% or more growth for the medium term. Thank you.
Thank you, everybody, for coming here today, and thank you, Fred. What I want to talk to you about today is Russia's economic forecast, and I focus entirely on one thing, economic growth, and primarily in the short term. Admittedly now, Russia's stock market has fallen by 50% in the last 4 months, but most economic data so far look quite good. The general view among forecasters is that Russia will stick to 6.5% to 7% growth. The statistics are rather boring because they look pretty good by and large. So I will skip much of the statistics and rather focus upon the qualitative measures. My sense is that the situation is somewhat more worrisome as the stock market reflects rather than what the statistics so far reflects. And I'll focus on this, 2 scenarios, causes of growth, and then, most of all, the concerns. I like giving these numbers. Russia's GDP, measured not in PPP, but in current US dollars, has grown by almost 9 times in 9 years. From almost $200 billion in 1999 to 1.7 or 1.8 trillion this year. 1.7 is the IMF forecast. 27% growth a year. And this is what matters to investors and businessmen and exporters, not the real growth, which has been 7% exactly a year. And of course the question today is, will this continue? The Russian government this spring issued a program for Russia 2020, and they have an innovation scenario there as the main scenario of 6.5% growth, and their worst scenario is an inertia scenario of 3.9% growth a year up to 2020. And my argument is that the innovation scenario does require substantial reforms. And the question is if Russia can come back to that. Right now the policies are rather towards the inertia scenario in the short term. Looking up at the causes of the high growth, it is what I would call capitalist convergence. Deregulation, privatization, and financial stabilization has worked, and indeed Russia is an open market economy. Exports are about 30% of GDP. And on top of that, Russia, as all post-communist countries, had a huge free capacity in production, infrastructure, and human capital. No less than 73% of the Russian youth go on to tertiary education. And on top of that, I only take it as a third issue, the oil price windfall, which has only been there since 2004. And looking up on the sources of growth, half of the growth has come from total factor productivity. And among those, are the three resources exhausted now? I would guess close to. Human capital is still improving. Allocation of labor is sharply improving. But the curious thing is that so far, every year, ordinary forecasts from the IMF that are based on demand, they tend to be 1 to 2 percentage points lower than the real growth, because it really comes from the supply side that these ordinary demand-oriented growth forecasts don't catch. And what I would like to emphasize today is that we are seeing economic concerns that are accumulating. In your folder you find an article of 10 reasons why economic growth is likely to decline in Russia that I published recently in Moscow Times. Basically, this is the end of a boom. Russia is feeling it, and few places are as overheated as Russia. The last 3 years, Moscow has been the most expensive place for business visitors, and you feel it. Inflation is up at 15% a year. Unlike China and India, Russia has a low investment ratio. Even now, after several years of growth, it's only 23% of GDP, and now it's likely to decline rather than increase. And Russia has massive needs in terms of investment. As you know, the Russian population is not increasing but declining, and the share that is active labor force is declining. There is a good opportunity in immigration and reallocation, but still there is no net increase in the labor force. What I would particularly emphasize on the next 2 points, that's an extreme corruption. Russia is today the 46th richest country in the world in GDP per capita terms. But according to Transparency International, it's the 143rd most corrupt country among 180. So it's a great disparity between Russia's richness and its corruption. And a peculiar thing that is little noticed, it is that Russia is essentially unable to build public infrastructure. Houses are built, even airports, because they are private, but roads are not built. Russia's paved roads have not been extended a bit since 2000. The same is true for oil pipelines, because they can't manage it. The money is stolen or not dispersed. And, of course, what you all have in your mind, oil prices are moderating, and oil and gas production is now stagnant after previously having had a substantial increase in the years 2000 to 2004 in oil production. And growth has been driven by trade. Russia is today a very open economy, but now the policy has turned against WTO. The forecast for the effect of WTO that David Tarr and others at the World Bank and Ksenia Yudayeva in Moscow have done suggests that it would be 0.5 to 1 percentage point extra growth a year. Without WTO, that won't happen. And renationalization is now a concern since 2003. And there is no sign of reforms in the social sphere. The middle class is essentially left alone. If you retire belong to the upper middle class, you can get a public pension that is 4 to 5% of your prior income, so people don't retire if you're not very rich. And the banking system is still dominated by state banks and is therefore poorly developed. On the other hand, might be positive today, but there is a little monetization. Russia does not suffer from an excessive leveraging. And this is a typical picture of what is problematic, that the oil production, after having increased sharply these years up to 2004, has then slowed down, and right now, I haven't got the last year, it is stagnant. And right now we have seen a recent crisis exposing vulnerabilities, corporate governance problems in the coal and steel company Mitchell and TNK-BP. It seems as if these are settled now, which suggests that the government has realized that we have to be careful. If the stock market collapsed on the war in Georgia, we don't see it in the economic statistics yet, though, and the international isolation has meant that the WTO suspended. This will have a cost, but we don't know how much it will be as yet, and a sense of political unpredictability. So what are my conclusions? Easy, aggravated contradictions between the strong market economy and political disinterest in pursuing further reforms. Macro remains strong. I've not talked about it. It's simply very strong and very solid. But vulnerabilities dominate the current picture, and growth is likely to fall. But even so, the growth inertia is so strong, so I think that we are likely to see a growth in the order of 5% or so, while you hardly see any forecast below 5.8% for the next year. Something negative is happening, but the inertia will probably carry Russia forward. Thank you.
Well, the last time I talked about Brazil in this room, I was discussing whether Brazil was going to default in the year 2002. I'm happy to say that that is not the topic today. It's a very different sort of topic. Perhaps I should also mention, since Arvind Subramanian mentioned it in India, that although I'm going to discuss the economics in Brazil, Brazil is certainly one of the the three of our 5 members of the $1 trillion club that is unquestionably a democracy today. The Brazilians take considerable pride in the fact that of the second largest number of people ever to have voted for an individual candidate were the people who voted for Lula last time. The first was, I think, Ronald Reagan in 1984. The second is Brazil. And considering that there are only 2/3 the number of people in Brazil, I think that is a considerable credit to Brazil. A number of you will be aware that Brazil has changed very emphatically in recent years, but the sort of caricature one gets of Brazil is to raise the question as to whether it really belongs in the company of the BRICS, because surely it's a slower growing economy. Certainly it has the reputation of being an inflationary country, which was heavily dependent on oil imports, if one goes back to the first oil crisis in the 1970s. And then it has the reputation of being the most unequal country in the world in terms of income distribution. I want to disabuse you of a few of those conceptions, if there are still people who have that view of Brazil. if one looks at the facts on growth in recent years, and one takes a somewhat longer comparison than Fred did in his introductory remarks and looks back over 10 years, then Brazil per capita income certainly has grown less than any of the other countries there. It's grown emphatically less than the most other members of the $1 trillion club. The only one that's anywhere in the same vicinity is Mexico, and but that also suffered from the period of the lost half-decade in Latin America in the late 1990s and early 2000s. If one looks at if one uses a simple model, which is due to Arvind Subramanian, I have to say, and one takes from that the expected growth rate at the present time, this simply plugs in the convergence term. It doesn't look at all the other factors that are relevant to growth rates, but it looks at the convergence term. Then Brazil doesn't do too badly. It comes in the middle of the group of countries that we're concerned with. A number of people also will be concerned about the comparison with Argentina. They'll be aware that Argentina has grown very rapidly in recent years, and one has even had the suggestion in Brazil, I have to say, that maybe it would be worth having a crisis in order to grow fast like Argentina. Look, if you go back 10 years, it just isn't true. Brazil and Argentina have grown at much the same rate over that period, and Argentina lost about a year's worth of GDP in the process of having its crisis. So it really wasn't worth it to come out 3% ahead, if indeed these figures are right. If one looks forward, as I say, then Brazil's growth is very much in the middle of the range of the $1 trillion club. And the main constraint on faster growth, I have to say here, I agree very much with the conclusion that Danny Roderick and Ricardo Hausmann came to after they went through their elaborate growth dynamics exercise. And they came to the conclusion that the constraint on growth in Brazil is low investment, and that's caused primarily by the high level of interest rates. As a matter of fact, I had reached much the same conclusion myself without going through all their analysis, but I was very glad to see that they came to the same conclusion as to what was the trouble. Let me talk a little bit about inflation. Inflation was stabilized in Brazil in 1994 with the Real Plan, and since then Brazil has been a relatively low inflation country. I say relatively, it's relative to other emerging markets. It's not low inflation by the standards of industrial countries. The target of the central bank, it is an inflation targeting central bank, and it has an inflation target of 4.5% a year, which we wouldn't think of as low in terms of industrial countries, but in terms of emerging markets, it's pretty low. And my explanation of that is that it's a very similar situation to Germany after its 1923 hyperinflation, which became inoculated against having a high rate of inflation. Well, in the same way, Brazil went through the longest period of high inflation of any country in history, even including China. When it came out of that with the Real Plan, there was a determination to avoid a repeat, and that is why inflation targeting was installed in the year 1999. The central bank this time around has been in the forefront of raising interest rates. It's raised interest rates even in its last meeting, and it's expected to do in the next meeting. I personally think it's somewhat overdone it, but nevertheless, the fact is that it is a highly restrictive monetary policy which is motivated by the attempt to control inflation. On energy, Brazil's essentially self-sufficient already. Even this is partly because oil production has increased over the years, and it's partly because of the production on a large scale of alcohol from sugar, which, unlike the production in the US of alcohol from corn, is highly efficient economically at anything like the present oil price. This is already almost all cars in Brazil can function on either alcohol or gasoline, and people vary between the two depending on their relative price, and most people at the moment are buying alcohol because it's cheaper. Despite that, there has been recently a discovery of a large, but it's certainly going to be difficult to exploit, offshore field of oil. It's difficult to exploit because it lies well below a bed of salt, and so in addition to all the difficulties of producing at sea, one has the need to drill deep, but this is something that is likely to come on stream in due course, and it's said that it's the most important oil discovery since the North Sea in the 1970s. There's a discussion in Brazil now as to whether a new state company should be created. The chances are that this will be a very small company. They've talked about having 60 employees, not 60,000, 60. And it will simply contract oil production to the existing companies. It'll then sell its share of the product and invest the proceeds, much on the model of Norway. So it's not a suggestion of a big expansion of the state sector that is being discussed in Brazil. Finally, on income distribution, Brazil has the reputation, I think it deservedly had the reputation, of having a very bad income distribution, but it is getting somewhat better, and it's getting better primarily because of the Bolsa Familia program, which meant these are conditional cash transfer programs, conditional on families keeping their children in school and having them vaccinated, and conditions of that sort is taking place. There's also been an expansion of formal sector employment, and this is not just because the labour force is increasing rapidly, which indeed is happening, but it's also true that informal employment is falling. And finally, let me mention that the Bolsa Familia program isn't just an unconditional giveaway with no questions asked, but that there are being questions asked, and about 5% of the people who apply are rejected because they have incomes above the appropriate criterion. Finally, let me say a few words about the short-run outlook. Growth in Brazil is still strong. It's still, the latest reported quarterly figure was growth of 6.1%. There's little prospect, I think, of a major spillover from the crisis. Of course, there's going to be some spillover to a country like Brazil, and there'll be some through financial markets as well. But on the other hand, the immediate impact has been to reduce the value of the real, the national currency, and that's likely to be helpful for growth. The inflation forecast is now only mildly above the target for 2010, that both the forecasts of the central bank and of the private sector are in the range of 4.5% to 5%. So they're still above the target, but they're not greatly above. And so hopefully next time, certainly the time after, one would expect the central bank to conclude its program of raising interest rates, and then one will again have it'll be possible to begin addressing what I regard as the main structural problem of Brazil, which is the very high real interest rate, by reducing the nominal interest rate, and that will have the incidental advantage of doing something to alleviate what I think was a serious worry of the overvaluation of the Brazilian real. Thank you.